Hello and welcome to Trading with Technical Indicators. My name is James Boyd. We welcome you here today. We also got Brent Moores in the chat. We welcome him. And we got many of you. We got Jay Richardson. Hello to you. Ray, hello, calling in from Spain. We also have someone else was in Costa Rica, Eric in Costa Rica. Yeah, so we're just going around the world here. Why not? Might as well. We also got Vlad, Michelle, Grace. We also have Luke, Bridget, and many others. Welcome to all. Now, just real quick, today's class, we're going to focus on kind of a timely topic. We're going to talk about diagonal resistance. I've had some questions, and I've kind of created some content that I want to kind of cover here today thoroughly, okay? So this is going to be a class that you want to go back and study. It's not just kind of a one-off topic. It's going to be a topic that you're actually very familiar with and you want to master. So just real quick as we get started, remember that the information provided here is for general informational purposes only. Options carry a high level of risk, not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of research. Our examples will be done in the Pape Money software application. And just remember with the software download, that could be in the real account and or a paper money account. You can do both. Also remember that investing involves risk, including loss of principal. Now, today what I want to really talk about kind of in breaking down, and I want to write this down, our topic is diagonal resistance. I've had some questions on this, and with those questions, I've created some content to try to help thoroughly answer your questions. So I want to kind of talk what it is, okay? I want to talk about the structure, okay? And I want to talk about the significance. Okay, why does, and anytime you learn something, you want to really know significant, sorry for the spelling. You want to know why is this relevant? How do we use the information or consider to use it? Second thing I want to talk about there is really mixing thought and feeling with technical analysis. And I'm going to relate that back to diagonal resistance. Third thing we're going to talk about is examples. These will be new examples. And the fourth thing I want to really talk about, and I'm going to have you do, is a homework assignment, okay? And this is where you want to really make sure, can you practice the information here taught? Now, I think what we need to do first is kind of break down the big picture. So when we talk about these different types of trends, right, we have been in, I'm just going to label this as T1, okay? T1 is the price, so this line, we're talking about price here. As the price makes lower lows and lower highs, okay, trend number one, that's what we've been in. We know that the price has gone down, and we know that the V, okay, volatility, has gone to the upside. In trend one, go back to price patterns, this is where you get bear flags. Now, you might like bear flags if you do bearish type of trades. But if you don't do bearish type of trades, it just kind of means it's pulling back on your overall bullish portfolio. Now, why are we talking about diagonal resistance? Well, you always want to kind of be one step ahead. If those bear flags, lower lows and lower highs, they don't tend to last forever. Feels like forever in the middle of it. But all of a sudden, we get to what we call trend number two, okay? And that trend number two, let me kind of take a different color here so we can see the difference. And let's go that baby blue. Now, if you look at this, this is where all of a sudden we were making lower lows and lower highs like before, but all of a sudden we come up, we pull back, and then all of a sudden we start to reverse, okay? If you think about this, is a diagonal resistance, and we're going to come to the detail on this, is really taking those lower highs and seeing that the price has reversed above the diagonal line. That trend two is where the price, okay, reverses, make it a little thinner, that price reverses, and where does volatility go, okay? So we're talking about where the price reverses, REV, and this is also a major point to this. This is where the volatility, not volume, volatility tends to decline. Some of you traders, investors out there, you're not just trading the direction of the price, you might be trying to trade volatility, okay? Now, this is also kind of what we talk about. This is where we start to, we get the momentum back, okay? This is the start of the momentum, and we're going to label this as bull momentum, okay? Now, this is also the start, okay, of what? Bull flags, okay? And all of a sudden, okay, it kind of gets interesting, perhaps. Now, let me kind of draw this. When we go to that trend 3, this is when we see, in this case, really higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. And everything just looks like a bull flag, okay? Now, some people will say to me, like, comments like, who can't make money in this market? I mean, it's just going up left and right. I'm not sure if we would go that far. Okay. But when we have a bull flag, this is where we tend to see the volatility, VOL, that's not volume. I'm talking about volatility declining, okay? Now, when we get into that trend 4, this is when we tend to get into those triangles. Price has been going up, making bull flags, but then we start to create maybe like ascending triangles or pennants. We could also be making maybe channels. And I want to kind of write that. So I'm going to write AT for an ascending triangle, ST for symmetrical triangle. I'm also going to put C for channel. Okay? Now, everything's fine at that point. But when we get the opposite of these trend 2s, trend 5, and it's really where we've been making higher lows, and then all of a sudden that trend breaks through the diagonal line. Example given, VIX. And boy, we don't mind to see that at all, do we? So if we start to break the diagonal line, this is what we call the start of bearish momentum. Okay, watch the trend lines. Now, also at this point, when you have bearish momentum, where does the volatility tend to go? The volatility tends to go up, so that VIX tends to rise. Now remember, VIX in market tends to be inverse, not always perfectly inverse, but tends to be more inverse. So our focus here today is really talking about this trend number 2, okay? This is, again, what we would kind of coin as maybe the start of bull flags, where we start to get maybe the trend to reverse, and so on, okay? Now, how did I learn about these, diagonal resistance? I learned about it because I was bearish positions, and sometimes only to see them snap back to the upside violently sometimes. And so I learned by losing potential unrealized profits or just losing capital in general. So sometimes your pain kind of becomes a great lesson, or could. The second thing is sometimes the investor would exit only to see the stock reverse right back to the upside, okay? So kind of learn from failure, okay? And I thought to myself, gosh, this would be really interesting if you were long and taking the opposite side of this. That's how I learned it, okay? Now, I want to kind of reference something. When we talk about these diagonal resistance, this could be, let me write this down. This could really be, in this case, it could be shorter term, okay? When I say shorter term, I'm talking about just days to weeks. It could also be something where we could say intermediate term. This could be weeks to months. It could also be long term. When you actually think of kind of what diagonal breakouts really are, these, I'm going to label them as DBOs from now on, diagonal breakouts, they are really bull flags, okay? They're really bull flags, okay? And they can be done in the short term, intermediate, or longer term. Days to weeks, weeks to months, months plural. So when we say DBOs, the investor is trying to catch these prices where they run up and where they pulled back. Now, we know in the recent market that we've been in, we've seen prices pull back. Well, when does it stop? That's what we're talking about today. So if that stock all of a sudden starts to get above the diagonal line, we could start to reverse this trend, and we're trying to catch the breakouts, okay? Now, what I want to also kind of bring out is, well, what type of products could this be on? Could be stocks, could be options, could be other products as well. It's not only to stocks or options. It could be absolutely other stocks and other shorter term time frames as well. So we mentioned before, when we talk about these diagonal breakouts, it happens, okay, after trend 1, okay, after you get pullbacks, okay. Now, the biggest actually thing is the diagonal resistance, okay, is created from lower highs, okay? And those lower highs is where the price drops down, comes back up, then falls back down, comes back up. It's created from those lower highs. Now, the biggest actually thing is when we take a look at this, the lower highs, okay, lower highs create a resistance line. Sorry for the spelling. Let me fix that. Resistance line. That resistance line is an angle as well, okay? And what's the significance of that angle, okay? The significance of the angle is important because this is where the investor might say, hey, James, I'm going to do like a buy stop order to enter or a buy stop limit order to enter. Or the investor might say, James, I looked at where the line was to see that angle, and I might even also do like an alert for an entry. And I should say a bullish entry, perhaps, question mark. Now, one of the comments that was asked before, which is kind of when do you know that bearish positions might be over? Well, a bearish exit tends to be, okay, a bullish breakout. So when we say a bullish breakout, it could be a horizontal breakout, sure, but it's probably more than not a diagonal breakout, okay? Now, that bearish exit, okay, could be a bullish entry, okay? And that's very important there. So a bearish exit could be a bullish entry. Now, I said that last week. That's kind of, and I said it with Kevin on Friday. That's kind of what you want to see. You want to see the price actually start to get above the diagonal resistance line so that way you have two things happening. Number one, shorts could be covering their short stock positions, but the second thing could actually be new bullish investors see that opportunity and they're trying to take it. Now, don't worry, we have examples coming up. Now, the biggest actually thing is the reason why this diagonal resistance, the DBO, is very important. It's the first sign of price making a higher high. So now I know what you're thinking. That's good, but I'd like to make a higher low. I know, but it starts with a higher high that's above the resistance line. Okay. Now, the significance is also it's a change in trend. And what do we mean by that? Going from a pullback, okay, pullback to the start of potentially bull flag, or just we would say the start of an uptrend, okay? Now, if we take a look at this, I want to kind of recapture something that I said before. Why does the angle of the line matter? Now, let me kind of just go back to a quick example. So what I'm going to do is I'm going to pull up this chart. Let's just pull up example given Cisco, okay? Now, what you're now going to notice on Cisco, and I want to kind of do this on purpose, when you look at charts, and I want to kind of, I'm trying to tattoo your mind a little bit, I admit, okay? I'll admit it. What you're going to notice is when you get an upward trend, you kind of get these diagonal lines, pullbacks, okay? You get these shorter term diagonal lines, pullback, and then it breaks to the upside. Get a little pullback, okay? Breaks to the upside. You get a little pullback, breaks to the upside. Get a little pullback, breaks to the upside. Gets a little pullback, breaks to the upside. Now, you might think, well, James, come on, you keep saying this over and over again. Well, for the people that traded the breakout, they don't mind to keep saying it. And now what you're going to notice is it broke to the upside. And then what do you notice again? We see, in this case, like another diagonal line. Now, what the investor is trying to target is something that's, remember I kind of said that a diagonal breakout, when you kind of think about this, it's a run to the upside and then pull back, flag. And the investor, what they're trying to do is they're trying to time that entry. And so what you're now going to notice is the investor is trying to get in on the breakout. Now, I want to make this as simple as possible, okay? If someone said, well, how do I see the breakout itself? Well, you go back to what we've already taught, which is it's a classic moving average crossover, among other things. And then all of a sudden, when it breaks out to the upside, you get a moving average crossover again. Break out to the upside, moving average crossover. So if someone said to me, how would I find these? Well, it's what I've just circled 4 times. The investor is really looking for those moving average crossovers. Now, don't worry, we're going to write that down in just a moment, among other things. So these are just those moving average crossovers that happen to coincide with diagonal resistance lines, okay? Now, let's kind of write this down before we forget, okay? So when we talk about how do we find these, how do we find these setups, okay? Now, if I had to kind of put in order that things that I think are the most important, okay, number 1 would be the trend column, okay? And that trend column, and I would put it in this order, okay? The trend column, if you go back to this, go to Market Watch. If we looked at, let's say, Market Watch, we'd go back to quotes, and I'll make sure that this is in the description for all of you watching the recording as well. Remember, if we're looking at, let's say, a list, example given, the S&P 100. If we were actually looking at the trend column, and let me send it to you live if you do not have that, it's also on my X page as well. What you're now going to notice is if I do this, you're now going to see, I just sent that out to you in the chat, there's the trend column. So if we said, hey, I am looking for stocks that could be in trend number 2, well, NVIDIA. We also see, well, actually, I got QCOM, I got NVIDIA, got Bank of America, and I got Oracle, okay? Now, if I flip this list and said, well, what do I actually see in the S&P 100? You're going to see other stocks like Netflix, GE, etc., BLK, Honeywell, and so on. So number 1 tool that we would look at for a diagonal breakout would be stocks that, are in this trend number 2 condition. If you said, I don't even know what that is, right-click on the heading when you load that script, go to Edit Formula, and just do a little reading. And that reading is going to really break down what does the number 1 or 2 mean, etc. And you're going to see that it gives a description when you scroll down. What is number 1? What is number 2, etc. Okay, it's written in there so you can read it. Go for it. Now, number 2, the other thing that I would say that is helpful is, so that we already did that, and let me just kind of put that script right there. Now, number 2 is the chart, I should say the trend script on the chart, okay? And the third thing before I forget is we would say the moving average crossover, X for crossover script. Is that more important than the number 1 and 2? It's not, okay? The moving average crossover script would be the third point reference. And if I said, is there anything else? We could actually look to kind of try to target this, the bull flag script as well, okay? Now, so first off, if I said, hey, trend script on the chart, what do you mean by that? Well, let's pull it up. Let's go back to the chart. Remember, we've kind of been hiding that little chart over here to the right-hand side. Let's swipe it over. And what I want to do is let's kind of bring this up. So what you're now going to see is the lines that I drew on the other chart, which I hid over here. Okay, you're now going to see that. How do we know that that trend changed? Now, remember what I said before, we can see where those flags are when we see the orange color candles and the purple color candles. Now, if we said it's been a shallower pullback, this is a test. If I said it's a shallower pullback, what color candle should it be? Orange and purple? Orange, purple, and red? Boo. Or orange itself? Well, if we said there was kind of a shallower consolidation, we would say, hey, it's the orange color candles. If it's only orange color candles, that means we've stayed very close to the recent high. So that's the answer. If we had a shallow pullback, only see orange color candles, okay? If we said they ain't even a pullback, okay? Green color candles, not as likely though. But if we saw a shallow pullback, just orange. If we see orange plus purple, well, that actually means there's been a more material pullback. Why does it go purple? The price falls down below the 10-day exponential moving average. How do we see the trend is changing? What we actually see right there is that color. We see the color of the candles going back to that lighter color green or dark green, signifying a breach in resistance. I need you to say that. Resistance. Not resistance. Resistance. Okay, now, if we take a look at this and we follow this every time. So remember I kind of said we would get the run up. How do we know where the bull flag pole is? Well, the bull flag pole, think of pole as price ascension in this case. Bull flag, okay, we're saying a bullish upward move. Well, it's just green candles. And then how do we know if this is a shallow pullback, medium pullback, deeper pullback? We just said that. If we only get those orange colored candles and then it squirts to the upside, shallow pullback. Does the investor want a shallow pullback? Well, think of it like your checking account. Do you want big pullbacks off the recent high, or do you want shallow pullbacks off the recent? Oh, okay, I'll never ask that again. Okay, good. Now, what you're now going to notice is a little run to the upside, a little bit more of a pullback. How do we know it's a little bit more of a pullback? Well, you got orange and purple color candles, okay? Now, how do we know where that potential entry could be? Well, we go green again. And so now the investor says to themselves, those green colored candles are my best friend ever. Well, that's for you to decide. Now, that does not guarantee that it's going to move to the upside. It doesn't guarantee that it's going to go up infinitely, right? And what you're now going to notice is uptrends are higher highs and higher lows. And there it is again. Now, what you're going to notice is also underneath, when we did get, let's say, that trend going, let's say, to trend 2 or 3, you're also going to see on that breakout day at the bottom of each one of these little yanks or these pullbacks, there's a green chocolate chip cookie. I'm joking. It's not a chocolate chip cookie. But if you look at this, there is a green dot on the chart as well, showing where that potential hold could be. Okay? So I think when you kind of look at those tools, now this one is kind of the example that we have not seen before, where we get the purple and red. What's the significance of the red? It means the price had to drop down deeper to get investors to come in to buy. Is that what the investor wants? No, I don't think it's what they want, right? I mean, it might be if you're looking to buy, might be closer to longer term intermediate support level, but you are acknowledging that it had to lose more bullish price momentum to get bulls to come in and those who were in to stop selling, okay? So I would kind of put those in those order, right? Trend column, okay? The trend script. Trend script on the chart, which I just showed. MA, the moving average script, okay? Now, I would say with this trend script, with that as well, you're also going to see that there is that hold script as well that's going to be showing on the chart. Let me share that with you so I do not forget, okay? Now, what I'm going to do is I'm going to put this right in the chat as well. That's the script for this chart. Now, when I pull back up kind of what we were mentioning, the moving average script, I think we've covered that, but if you said, I don't have that and I need that, okay, the moving average script is going to be right here. And let me just send it to you. Those watching on the recording, I'll make sure it's in the description. That's the moving average script. And the last but not least, if you said, hey, I'd like to kind of see this in different ways, the bull flag script as well, okay? That bull flag script as well, just want to make sure we cover how do you find them, okay? Let me put that there. Remember, these are also on my X page as well. And there it is, okay? So it's very important. A lot of people say, how do I find them? Those are 4 ways in which you can find them. Now, I label them in kind of order of importance first. Trend column being number 1. Trend script, visually seeing it. But if we looked at a moving average crossover, a bull flag script as well, we could probably also see those as well. If we kind of said what's our favorites, if there were, we'd say 1 through 3. 4th would actually be kind of a miscellaneous one that could, but maybe not as timely as 1 through 3. Okay? Are there any questions there? Any questions? Okay, good. All right. Now, what I want to also kind of just do is kind of bring out is let's kind of talk about just real quick, scroll back up to something. So we talked about kind of what it is, the structure, the significance. The one thing I want to kind of say just real quick on the structure is when we're talking about diagonal resistance, we are looking for a pullback longer than 10 trading days. The significance of the duration of the pullback has to do with lower highs don't happen every day typically, okay? So to create lower highs that's creating the diagonal resistance, it takes time. So when I say 10 trading days, I'm really saying in this case, 2 weeks of pulling back. Because when you have a pullback, lower lows and lower highs, that takes some time. So the minimum pullback to really say, hey, we have a diagonal resistance would really be 2 weeks of trading or 10 trading days. Now, I want to kind of also go back to something just really quick when we talk about kind of drawing the line. And then we're going to move to kind of thoughts and feelings just real quick and kind of how we could fall into a trap. Well, when I draw these lines, and let me kind of bring this back up. When we're drawing the diagonal resistance, and this is going to be part of your homework, when we draw the diagonal line, we're not drawing from the bottoms of the candles. We're drawing from the top rights of the bodies of the candles. Why? Well, the top rights of the candles, not the bottom. So if I drew this kind of like this and said, well, James, I'm going to kind of draw it from the bottom. Well, that would be like support, okay? That's why we don't do it from the bottom. We're kind of looking to say, hey, in this pullback, if I drew it from here, how many of those candles can I nick, okay? And when I draw that, I'm trying to get an angle of resistance. And I'm trying to kind of look and see how many bodies of candles can I hit. He or she that touches the most number, candles, bodies of candles, okay? That's probably where they see the angle of resistance. We mentioned before, why is seeing the angle of resistance so important? Well, that's where you might be setting a buy stop off, okay? If it gets at X amount or dollar amount above that high. That's where you also might be setting an alert, okay, as well. Now, what I want to do is I want to kind of come into some examples here, and I want to bring back up a stock, and I'm going to start with just really quick Netflix for just a moment, okay? So let's imagine you said, James, I went to this class, and now I'm going to try to do it myself, okay? Now, I don't know how you feel, but when I see other people do it, and I go out and try to do it, sometimes I'm like, man, dadgummit, it's a lot harder than it looked. Now, when we go back, how far do we go back? Well, the answer is we're going to go back probably about the last 2 to 4 weeks. Why 2 weeks? Well, because we said that when we see the angle of resistance, we need at least time to go by to get lower highs. The lower highs is what's creating the diagonal resistance line. Now, what you're now going to notice is if I went back 2 weeks or so, drawing from the top rights of the bodies of the candle, if I drew a line like this, that's about 10 days right there, okay? If I went back a little bit further and said top rights of the bodies of the candles, it's not going to give me that much of a difference. But if I went back, let's say 2 weeks, or I went back 20 days or so, the lines, I'm nicking the top rights of the bodies of the candles. So that's something that you need to practice. Now, what happens if you don't draw them like that? Well, you're probably going to struggle on having the confidence to practice setting up the orders for entry, okay? Now, what you're now going to notice is, if we took a look at this, what you're now going to see is the price gaps above the diagonal line. If we were going to close here, well, this would be like a breakout. The whole body of the candle is above the resistance line, okay? And we want to see the closing price above the open. Does anybody know why that's important? Well, you want the closing price above the open, so you actually see that it didn't just gap and then fade, but it gapped and ran to the upside, meaning people bought it even though it broke out. It pushed and closed higher on the day. And what would that probably do to the indicators? The MACD would poke you in the eye. I'm just joking. It wouldn't do that. But the biggest actually thing is the stochastics would probably also come out of that oversold territory, okay, as well. And that's where the indicators are confirming what's happening with price. Now, if we take a look at this, what type of strategy? Well, let's kind of bring this up. Now, remember, why would an investor want to know about diagonal resistance breakouts? Well, not only from trading the price, what could be examples of the strategy? It could be a stock position. Last week, we talked about dollar cost averaging to the upside. So the question was asked, dollar cost averaging when the price is dumping down? No, we didn't say that. Dollar cost averaging if the price were going to go higher, okay? So number one is the investor might say, I'm going to do the stock. Second thing, they might say, James, I'm going to do a cash secured put. Third thing, similar, a short put vertical, a long call vertical, and so on. Why the last two of those four cash secured puts and short put verticals? Well, because they're trades that are kind of based upon volatility, probability. Now, trade number one that we're going to do here, based upon what we talked about, is we're going to go do a short put vertical. Now, why are you choosing a short put vertical? Well, it's a $953 stock. So if you did a cash secured put, you need to tie up a higher amount of funds to do that. So we're going to do a trade in this case that really has a built-in maximum gain and loss. Now, I'm going to pull up the paid money account. And when I do that, I'm going to type in this Netflix position. Here it is. And what I'm going to do is I'm going to go out 20 to 50 days to expiration. Okay. Now, let me kind of just loop in here things that happen. Now, I'm not making fun of anyone that says this because I've said every one of them. Okay. Now, remember when we kind of talked about what are some of those thoughts and feelings that come in with this technical analysis? Well, the thoughts and feelings that come in right now is comments that we'll see sometimes is we will have to wait and see what happens. Wow, that's so instructive. I'm so glad you said that, and I have you as a friend. Maybe not, okay? But the bottom line is you could say that at any given time, okay? Sometimes people say that. We'll have to wait and see what happens, okay? What does that even mean? Second, I'm looking for a confirmation. Now, this one has a little bit more meat on it, a little bit more teeth, where the stock actually breaks to the upside, and they're maybe looking for a pullback and then a bounce to the upside. So that is an investor is waiting for more confirmation. Now, wait. Could they not dollar cost average to the upside? They could. Could they try to add to that bounce or to that trade if it was to confirm? That's the point of what we talked about last week, okay? And so the moral of the story is consider stopping, waiting to put your whole position on at once. There's dollar cost averaging for a reason, okay? Now, the other thing is, well, I'm not going to get in because the volume lately in the last couple of days in the breakout is lower. Now, you already know how I feel about this. I've seen this for years, okay? You got to understand something just quickly is when markets sell off, the volume tends to be higher. Why? Well, because they want to exit and they want to try to profit take and or protect their capital. It's almost like a fire. Fire. And people run out the door. But when people all of a sudden, okay, come back in, they're just kind of walking through the front door. And the volume now on the breakout tends to be lower in comparison to the selling volume. And so it normally is not as high, okay? So you just have to understand that. You're comparing buying volume after a sell-off, okay? And if you said a comment like, well, I'm going to wait, that volume looks lower, I want to see the confirmation, okay, that volume is going up and confirming it. You're comparing selling volume to buying volume. I don't think that's a good comparison. If you go back and look at this, 25 years worth, you're going to see the volume on the breakout compared to the selling volume is going to be about 80% of the selling volume. That's what you're probably going to see. Now, the other comment is I'm going to wait for it to get above certain areas of resistance, okay? I'm going to wait for it to get above 950 and then I'm going to get in, okay? So you got to remember is at these old levels, when we come down, run back up. Come down, run back up. These lower highs probably become areas of potential double tops and or equal highs. So it's understandable that someone says that, but you got to remember is it could reverse, okay, and get up through those levels. You also got to think about this from like a Fibonacci perspective. If we said, let's say on this, that let's say Netflix was at the top here and it fell all the way down to the bottom. Well, if you look at where we are here now, it got above the 38% line. Well, you might say, well, I'm going to wait for it to get above the 50% line before I get in. But you're kind of like missing the point though. If the diagonal line breaks, did bearish investors probably get out, the majority, or are they still in? Now, I'm throwing a question out there, okay? Shorter term bears probably exited. Could there still be some bears? Sure. But you got to understand something is if you start going up past the 23 to the 38, you get past the 50, all of a sudden the chances of a reversal further to the upside becomes higher and higher and higher. Again, consider dollar cost averaging to the upside. Okay. Now, also when you do trend reversals, diagonal breakouts, feel free to look at these Fibonacci lines. Okay. Be very careful on saying, I want to see it get above X level. If you said that, it's kind of like you're just rubbing dirt all over the diagonal resistance line, which is probably the flag breakout, okay? Now, I want to come back to that example on this. And if we did this and said, okay, we're going to go look 20, 50 days to expiration. And then on that 20, 50 days to expiration, we're going to pick the 17th April expiration, the monthlies. We're going to go to the strike that really actually has a delta, okay? Let's say we kind of chose a delta between 30 to 40. Now remember, a dual meaning for delta, okay? Delta is the change in the option price given a change, a $1 change in the stock price. It's also a probability of expiring in the money by a penny, okay? Now, if we chose example given, hey, we're going to go look at, let's say, the 900s, and those are wide bid-ask spreads. So those are $1.50 wide. I might have to go in a little bit closer. Normally don't like to do that, but based on the spreads, those were a little wider. And I want to also go back and just double check the open interest. Now, I'm just kind of hunting just real quick to see where that open interest is. So if we looked at the open interest like 11 days, a little bit more action there on the open interest, okay? When we go back, let's say the 4th of April, do they got any action there? Yeah, a little bit. Now, we were like 20 to 50 days to expiration, but when we looked a little bit further, we did not see liquidity, okay? We're going to do this example where we sell like the 940, let's go 945. Gosh, these are, at least in this case, since it's a higher price dollar stock, they're a little wider, okay? A little wider as in like $1.50-ish. And then if you got the middle, it's probably at 75 cents between the bid-ask spread, like mark to the bid or ask. I'm going to right-click on that. I'm going to go to sell vertical. Now, the wider that spread is, it's probably not something that the investors say, I'm going to trade actively on this. They're going to try to hold it for a couple days, okay? Selling the 940 and then buying the 930, okay? Credit here, 377. The strike that we're selling, the 940, has a 40-ish delta. If you choose a higher delta, are you more bullish or less bullish on the direction of the stock? If you pick a higher strike and or a higher delta, you're saying you're more confident on the direction. Now, with that, there's a built-in maximum gain, maximum loss. So when you go back and look at this and say maximum profit, maximum loss, there you go right there. So if you are wrong and it goes down, there is a built-in maximum loss built into the vertical, okay? Now, what we're going to go ahead and do is we're going to go ahead and send the order. Trade number 1, trading Netflix, a little reversal, potentially back to the upside. You also notice that kind of with where we are now, you are seeing that moving average crossover. Now, you will also notice on that moving average crossover and or breakout, there is your hold script as well. Now, I want to kind of make mention of just 2 other stocks that we're going to kind of just practice drawing the diagonal lines, okay? Now, if you said, James, I am one of those people that's having a very difficult time seeing the diagonal line, okay? Don't worry, we can help you. We're going to go to style, and if we went to chart type, I'm going to go to Hawk and Ashi. And what this kind of does is it kind of breaks down or kind of takes some of the noise out, okay? And what I'm going to do is kind of imagine we're just going to kind of circle the recent highs, and then we see where the price went down. And then where did the price go back up to before it fell back down again? I'm going to circle that. Price fell back down, price came back up, and then so what we got is we got 3 circles or ovals now. Well, why is that important? Well, because when we get those three ovals, we can now just play dot to dot to dot or circle to circle to circle. Okay, so how do we know where to circle? Well, when we drop, we did it from the high, where it fell down, came back up before it fell back down again. Fell back down. Price came back up. And then price came back down. So the ovals are where the stock stopped going up and it started going back down again. That's where the ovals are. Those points are the lower highs. You make a high, you make a lower high, you make a lower high. That is your angle of resistance. Now, what do you see on this one? Well, if we kind of take this to the right, you're going to see that today the price getting above the diagonal line. Now, this class is trading with technical indicators. Well, the indicator that we talked about 2 weeks ago was the stochastics. And what do you know? The stochastics was in the oversold, and is now kind of in the middle, okay? Now what you're going to see is the MACD gone green, had been green for a while. And so all of a sudden now here we are. Now, this is always the question. How do you know it's going to go up? The answer is we don't know if it's going to go up. We could see on any given trade, there's risk on all of them, okay? Now, if we went back and looked at this and said, okay, so what do we see? And if I was to look at this level, probably about right there, if we said, where might the stock try to go to if it did? Probably about 198. If it got above about 198, what you might see is it might try to go back up to the prior high. So the investor might say, well, James, I'm going to wait for it to get above here. But then if the stock got above here, then that investor says, well, geez, now that I'm late to get in, the reward to that prior high is not as high. I know. That's why the investor is trying to get in when it's closer to the low on a breakout. Okay? So by waiting, it ain't free. It costs you something, and you're buying a little bit more elevated off support. Now, let's do this. What we're going to do is going to kind of play that probability again. We're going to go to Dash, okay? And what I'm now going to see on Dash is we're going to try to sell a cash secured put if I can, if I have the capital to do so, okay? Now, what I'm going to do is I'm going to go down to the 180 strike. And if I did the 180 strike, what you're now going to notice is it's a 520 bid, 535 ask, delta 31. Now, what I'm going to do is I'm going to buy a put out of the money. So this is going to say that we're really doing a vertical. What we're really doing is just buying a put below the strike that maybe has a delta of 10 or less. Why? Well, because that creates a maximum gain that's not at zero, okay? Now, when you buy that put with a delta of less than 10, what that does is it does cost $1.07-ish, but what the investor is trying to do is also trying to minimize really how much money they're tying up to do the position. Now, I want to kind of give you a specific homework assignment to go out and practice here. So I got 2 minutes here that I want to give you the homework assignment, okay? So number one homework assignment, takeaway, is I want you to practice drawing diagonal, okay, lines over the last 10 to 20 trading days, okay? Now, I also want you to practice buy stop or buy stop limit orders, okay, based off the diagonal line. So a lot of investors, they're using the diagonal line to set up a potential entry. And I'm also going to include with that alerts, okay? Now, I also want you to make sure that you apply the scripts in the Market Watch, okay, Market Watch or charts. That way you can follow through on that, okay? So I'm out of my time here. But the reason why this was time specific is because diagonal resistance breakouts happen in trend 2. We've been in trend 1. And so if we start to get some reversals on price, these diagonal breakouts would probably become more and more evident that some of the bears are losing control of the price and that they're exiting and that some bulls might be trying to get back in. That's why we want to give you practice as we're maybe starting to see some of that. Okay, I'm out of my time here today. Thank you, Brent Morris, for answering the questions in chat. These are the things that we really wanted to go over here today. And so we did that, and we want to make sure that you follow through with your homework, because this will be a theme of what we cover this week. And we also did 2 sample trades. Now, remember that Cameron May is coming up next with getting started with options. Also want to give us a quick reminder that with what we discussed, it was done for example, illustrative purposes only. And also remember that all investing involves risk. And we want to make sure that as you go out and practice these specific things that we talk about, you might have questions. If you have questions, feel free to go to my X handle at James Boyd CS, at Brent Moores CS, capital first name, capital B for last name, and same thing with Brent Morris. Feel free to ask us questions there, or just questions in the comments from this video. We'll see those both. Thank you so much for your comments. Stay tuned for Cameron coming up next. Take care. Bye-bye.